Hi, thanks so much for joining in. You're watching NDTV Profit, and this is the Mutual Fund Show. My name is Alex Matthew. Now, there was a lot that was announced in Budget 2024, and you've probably gotten a breakdown of quite a bit of that. But when it comes to your mutual fund investments, you need to understand what the implications are, and you need to zoom out a little bit and think of what the implications are, not just for FY25, but also going forward as well. And it's not just an implication for equity and your equity strategy, it's also something that you have to take into account for fixed income. Should you change the way that you invest in fixed income mutual funds? What is the likelihood of a change in the bond yields because of what was announced in the budget yesterday? To talk about all of that and more, and also, in the second half, we're going to be talking about the changes in the capital gains tax and how you should adjust your portfolio, if at all. But at the start, to help you understand how you should adjust strategy, who better to ask than the fund managers who manage your money in the first place? We've got Srijatta Bhandwalkar, who is the head of equities at Canara Robeco, and we've got Avnish Jain, head of fixed income at Canara Robeco. Thank you so much, gentlemen, for taking the time. I will take your initial feedback and your initial thoughts on Budget 2024. It's been called pragmatic. It's been called, positive for the prospective employee. What do you make of it? Sridatta, I'll come to you first.
Sure. So I think clearly, as you said, it has been very pragmatic budget, and it is broadly continuation of the policies that this government has been doing for 10 years. So if you look at the first thing, there's clear and consistent focus on fiscal consolidation. So it continues despite so much of clamor for going populist. That's first. Second, there is clear focus of even on the basically rural side or urban development or the housing side. There is a clear focus on actually asset creation and spending money on the areas where it will be more productive, and in that continuation, the additional scheme this time that has come around, which is basically that trainee program or trainee of the prospective employees in through the private corporates that has come in. So all in all, when you look at this budget, clearly a fiscal consolidation as a theme clearly comes out. The additional 0.4% of additional dividend delta that they have predominantly spent it on actually reducing fiscal deficit, and then additionally the two states, which is Andhra and Bihar, that has gotten the money. There has been nothing in terms of disproportionate populism and giving up on the fiscal consolidation path that has come out of budget. So it's from a macro perspective, it's an extremely good budget. Yes, from micro perspective, a lot of us were hoping that there will be demand drivers on the rural side, on probably on the consumption side. There's nothing additional apart from a little bit of a tax break that has come through in the budget on that side.
Yeah,
so that's, I think,
and also changes in the long-term capital gains tax on equity, which a lot of people were hoping would not come to pass, but which has come to pass. But I think broadly a positive move in terms of rationalization of the tax structure in the capital gains side as well. But I'm curious, Avnish, on the fixed income side, there's a lot that has already been baked into the yield curve. I'm curious about what strategy you're espousing when you're investing in bonds, and what do you make of the fact that fiscal deficit has come down? It's likely to come down to 4.5% in FY26 as well.
So I think from a perspective of bond markets, its budget has been good, extremely good, as Shri also pointed out. The macro parameters continue to remain strong and stable. Fiscal down is another positive, though in terms of borrowing numbers, there is only marginal decrease in borrowings. Market had priced in already a good amount of the good news. And I think going forward, we are forward looking to the West Federalism meeting on 31st July and post that RBI policy meeting. I think while there is no rate cut expectations from either of these two meetings, they will set the tone for the next meetings. I think that is what the markets are looking for. Continuity of what they have been saying, no surprises. From a bond perspective, I think the passive flows which have been coming from JP Morgan bond inclusion is helping our market a lot. And we already seen almost 10 billion plus inflows in this current year. So that's extremely positive. And from demand supply perspective, demand side is pretty strong with the FI flows. So overall, the curve is likely, our view is that it is likely to ease from here. We had seen some flattening happening in the early part. Now we are seeing some steepening as short-term bonds also move down. So markets are pricing in some sort of easing, whether it's in liquidity or rates. Fed is expected to ease in September. RBI may or may not follow, but we do expect 25 basis at least this year from RBI. I think all in all, for investors, there is options, opportunities for making the mark-to-market gains by investing in long duration bonds.
Okay.
And obviously from the yield curve.
Okay, so I will circle back to you on specific strategy as well, but Sridatta, I'm coming to you. We spoke a few days back and we spoke about how you're managing your portfolios, your equity portfolios. Not too much has changed this week in terms of the multiples, in terms of the fact that in certain pockets valuations might appear a little stretched depending on where you're standing. So how are you positioning yourself? What is the strategy that you're employing when you get cash? How are you deploying it?
Sure. So as we said that there was of course an event, but that event has been continuation of the policies that were there for even previous 10 years almost. So if you actually break down it before going to the portfolios in terms of where the spending has happened, predominantly the infra investment or the capital investment continues to actually grow at 17%. The budget numbers have not changed. There is no significant change in the rural expenditure. So portfolio positioning from that perspective, where the earning cycle is, doesn't seem like will dramatically change because of this one event. Yes, there are challenges in terms of valuation in some of those baskets, but still from a portfolio perspective, domestic cyclicals is where the earning cycle is, because our still belief is, and that's what government is also implying through the budget, that we have done what we could do. Now we want to focus on fiscal consolidation more and more. Private capex is something that should crowd in, and that's where predominantly the earnings are. So if you look at the domestic economy, predominantly the earnings growth is in financials or part of financials, industrials, auto, real estate, hospitals, hotels, telecom, pharma. These are the spaces where predominantly the earnings still remain resilient. Yes, the challenge in some of these spaces, and not all of them, but some of these spaces is there is a valuation upfronting to a significant degree that has happened, whereby you need incremental surprises from private capex, as well as incremental surprises from the volume growth in some of these spaces. So that's where the challenge is. But still, predominantly the portfolios at aggregate level remain overweight on this side. Yes, there is other part of the economy where there was a lot of expectation that there'll be push to probably rural, there'll be push to consumption. But I think my assessment is that the central government has taken this position that, okay, state governments, and 10 of them have already announced a lot of schemes which are towards consumption, rural, populism. So there is anyway state governments which are going to do a lot of heavy lifting on that side. So it's better off to actually reduce the public debt at the central level and keep reducing the cost of capital for the country or interest rate for the country. So clearly, the state governments are the ones who are pushing the other side. And clearly, from portfolio perspective, those are the parts where the expectations are really low. For example, the mass consumption, the mass auto, low-end auto, the low-end real estate, anything and everything that is mass consumption side, mass retail, that has been struggling for last 2-3 years. My hunch is that given where their valuations are, there is an opportunity there. It is not clear in terms of the earnings upgrade cycle there, but from a valuation, expectation, ownership perspective, those are the pockets where probably the state government's incremental spending might end up helping those sectors. And that's where we are actually looking at incremental opportunities. But as of now, they still look like more tactical opportunities than structural opportunities. Structural growth drivers still remain on the cyclical side, because you had public capex, you will get the logical sequencing is you will get private capex, then you will get a full-fledged real estate cycle, and then logically you will get a mass consumption. That is typically a business cycle phenomenon. We are in between it. Let us see whether it plays out fully or not. If it doesn't play out, of course, the portfolios will gradually have to shift to the other side where the expectations are really low, but no earnings upgrade cycle as of now.
Oh, okay. All right. I'm guessing you will also increase weightage in sectors where you think that there is a likely outperformance going forward. But then we'll touch base with you at that point. Let's talk about where in the yield curve the most opportunity lies. You mentioned that there is possibility, Avnish, of a more downside to yields going forward. And so therefore, where are you positioning yourself? In what tenors are you seeing the most opportunity? And what is the extent to the decline in the yield curve that is possible?
So, good question. I think market yield curve is practically flattish if you look at that. Obviously, because there was no rate cut expectation building up for some time, we saw a rally in the long end, mid to long end of the curve, the belly of the curve and the long end. Long end has been long supported by good demand from long-term investors like insurers and pensioners. So there is good demand there. Mid end has been supported by traders and investors. What we are seeing now is some money is moving to short end of the curve. We are positioned mostly in the 10+ year curve because we don't expect RBI to move at least for one or two more policies. Short-end curve will move only when RBI rate cuts rates or injects liquidity on a durable basis, either directly or implicitly. So we will still be waiting to play the mid to long end of the curve. The short end of the curve probably, if we get indications in the next policy or so that there is possibility of RBI cutting rates in the next few policies.
So is 30 basis points possible on the downside for the yield curve on the 10-year?
Without a rate cut, it is unlikely because the market is now stuck in a range of 95 to 7%. And market is waiting for some indication from RBI for a rate move. If Fed cuts rates or Fed indicates a rate cut in July and it cuts in September, then market might move 10-15 basis points down from it.
And to talk about the winners and losers post-budget 2024, I'm joined by Vishal Dhawan, the founder and chief executive officer of Plan Ahead Wealth Advisors. Vishal, thanks so much as always for taking the time. And there are some very clear winners and losers from that mutual fund basket, and it's quite a large basket to talk about. But one of the clear losers are equity mutual funds, because you're seeing that long-term capital gains tax has increased. But there's also arbitrage funds, right, where people were gravitating towards post the change in the tax treatment on fixed income mutual funds. Is that advantage completely out of the window now?
So I think one needs to look at this in a slightly sort of different way. I think the equity mutual funds long-term capital gain tax increase is obviously looked upon as a little bit of a deterrent because there has been this increase by 2.5%. But we need to remember that there has been a lot of trading activity that has been happening on stocks as well as mutual funds, because the differential between short-term capital gain and long-term capital gain was only 5%. And what has happened simultaneously is that you've had, this whole opportunity get created where the short-term and the long-term both have got increased, and the short-term has got increased even more. And therefore, one of the things that we clearly believe has happened is that, you do have a sort of longer-term orientation that is coming through taxes. Now, one of the things that I think all investors need to be believing is going to happen going forward as well is that this is the start of a journey where tax rates will gradually keep going up on capital gains. And we think this is just a glide path that is sort of got initiated. So investors need to be looking at equity as an asset class by its characteristics rather than just the tax treatment around it. It's a small determinant of wealth creation over long periods of time. One additional thing that I think investors...
Sorry, no, please go ahead. You were making a point.
Yeah, one additional thing that I think investors need to be mindful of is that there has been a a sort of a rationalization across asset classes, not just in one place. And therefore, because you're seeing rationalization in different places, you are starting to see that more and more decisions around where to invest or where not to invest are going to get driven by completely by the asset class choice rather than by any sort of tax uh, preference between one asset class and another.
Yeah.
And I think that's great for investors because what it now does is it goes out and literally lets investors make asset class decisions by the characteristics of the asset class rather than by tax rates.
That's a very fair point, but specifically on the arbitrage investment, Vishal, a lot of people, because your gains from your liquid funds, your overnight funds, which are typically used to park money for short periods of time, are treated at slab rate. Irrespective of the time period of holding, people were gravitating towards arbitrage funds because the short-term capital gains tax was 15% and the holding period less than 1 year. More than 1 year, of course, it would attract long-term capital gains. Now that is becoming 20%. So would you say that the gap has narrowed and therefore it doesn't really matter if you put investments into liquid funds for short-term requirements or arbitrage funds?
So I think there is still a gap. I think it depends on the tax slab of the individual investor. There are obviously investors who are, in the 10-20% tax slab who would find now that liquid funds or other sort of overnight funds are as efficient. Whereas, people who are in a higher tax bracket, 30% or even higher because of surcharges, will still find the gap is quite meaningful. I think there is one additional point that investors need to keep in mind here that, while we talk about parking short-term money when we make certain decisions, we need to keep in mind that very often the short-term money actually becomes long-term because that need never really arises. And when that happens, suddenly that 20% tax rate on short-term on arbitrage will become 12.5%. So I think that there is still merit in looking at arbitrage funds. What, however, needs to be very, very importantly kept in mind, irrespective of the budget, is that arbitrage funds are not really designed for parking money for a few days. And that's why some of the arbitrage funds even try to, sort of disincentivize investors from doing that by having short exit load periods to give the message that this instrument is actually more like a 3 to 6 month instrument rather than literally to park money for a few days or a few weeks. I think that's both are important elements.
That's a fair point. I want to talk about another category before we get into those few hybrids where there's been a change. But the other area which can be a clear winner is the treatment of gold index funds, gold ETFs, and fund of funds investing in international equity. Previously, they were taxed at slab rate. And now there is a very clear understanding that if they're held more than 2 years, then it becomes long-term capital gains tax. Of course, short-term capital gains tax is still at slab rate, but the long-term is definitely a benefit, wouldn't you say, Vishal?
Absolutely. In fact, I think there are two elements here. I'm going to separate out gold and the international fund of funds here. So as far as gold is concerned, one of the challenges for investors was always that depending on how you chose to buy gold, you got taxed differently. And this seemed a little bit of an anomaly because if you bought a gold ETF or a gold fund, it had a different method of treatment, definition of long-term, etc. If you bought a sovereign gold bond, it had a different method. So it was very complex. And, this whole rationalization of, tax slabs, tax treatment, holding periods, which has come about in the budget, has probably helped to simplify, though there is still a difference in the sense that a sovereign gold bond continues to be very tax efficient to hold for the 8-year period, and you don't need the liquidity on that instrument. While gold funds can actually be treated differently because of this sort of change. Clearly, gold becomes more attractive, but again, the reason for buying gold can't be because now the tax treatment is different or more attractive than what it was. Gold is also a long-term asset class. We've seen through long-term data that gold can go through periods where it does very poorly, and then there can be periods where it does really well. So the decision to decide once again needs to come on merit of the asset class in the portfolio. As far as the international funds are concerned, I think that's a very big thing. And obviously, one of the restrictions that we have today is there aren't so many options available. But assuming those limits also change over a period of time, earlier what was happening is the tax treatment of international versus domestic was so distinct from each other that a lot of investors just went towards domestic equity in spite of the diversification benefits just because of tax. And once again, by making the shift, I think investors are going to get the opportunity to go back to deciding on asset classes basis the merit of the asset class, decide on the vehicle choice based on that decision. So I think that's where this is a very, very positive, good shift, that suddenly investors have the whole world open to them to decide on where they want to invest depending on the opportunity.
Vishal, quick follow-up to that. A lot of these funds had closed when limits were hit. But as things stand, which are the ones that are open and available? I'm talking about fund of funds, international fund of funds.
So there are, rather few of them available right now. I think some of the examples that you can look at is, SBI has a fund which is in collaboration with Amundi called the SBI US Fund. There is, some of the funds that allow SIPs to happen. For example, if you want to go into the Motilal Oswal S&P 500 index fund, you can actually run an SIP there. If you want to take exposure to China, for example, you can take exposure to through a Greater China Fund or an emerging market fund as well. So there are some pockets of opportunities available, but it's clearly not a very wide range of options that are available for you to participate.
The last point, and we have just about a minute and a half, hybrid mutual funds with more than 35% equity and less than 65% equity. The holding period change has been announced, right? So now you're talking about greater than 24 months becomes long-term and it gets taxed at 12.5%. Is that significant? Which mutual funds fall into this bucket?
So it is a category of funds that's not the most popular because a lot of what has happened in the industry is that, many multi-asset funds, many, funds which were hybrid were trying to go more towards the equity taxation. And therefore were trying to get the 65% benefit in any case. I think there was a few options which were available. There was a fund, there were a few multi-asset funds and some specific funds, like Device had a fund which was in this bucket, which sort of, took advantage of this. Now, realistically, in something of this kind, a 20% without indexation, and a 12.5%, a 20% with indexation and a 12.5% without indexation are not dramatically different from each other, because if you look at indexation rates, they have on an average been anywhere between 3 to 5% if you look at data. And therefore, between the two, again, I don't think things are dramatically different from what you were doing. I think ultimately as an investor, you have to figure out what's the kind of underlying asset mix that I want to have in my hybrid instrument and make my fund selection decision accordingly. And that's why I keep going back to the point that the beauty about what has happened yesterday is suddenly tax is not the hero of those decisions. The hero of those decisions are actually the underlying asset class.
Which ultimately is what we continue to preach on an ongoing basis. Thank you so much for reiterating that and for joining us on the show, Vishal.
Thank you so much.
All right, that brings us to the end of this edition of the Mutual Fund Show. Once again, if you've got questions for us, you can send them to us on the number that should pop up on your screen at some point. Maybe tomorrow we'll talk about it again. But there's lots more coming up over the course of the day. Do stay tuned. This is NDTV Profit.